Since November, both US and European banks have pivoted to an ultra-defensive strategy, influenced by evolving economic conditions and geopolitical uncertainties. Instead of lending to businesses and households, they've poured billions into government bonds. The latest data from January shows U.S. primary dealers holding a jaw-dropping $277.5 billion in Treasury coupons, a record high. European banks are following suit, hoarding government bonds despite rate cuts from the European Central Bank. But why this sudden pivot? The stakes for the global economy are massive. These decisions ripple outward, impacting not just businesses and financial markets, but the lives of ordinary people. From small business owners to first-time homebuyers, the fallout of these banking shifts affects everyone in ways that aren't always obvious. So, let's break it down. This isn't just an American phenomenon. Across Europe, banks added $232 billion worth of government bonds to their balance sheets in 2024 alone. At the same time, lending to the real economy has significantly slowed. For example, in Europe, lending to businesses increased by a mere $1.24 billion last year, a rounding error compared to their bond purchases. In the US, lending has barely grown outside of specific sectors like investment funds, which saw a 28% increase since the Silicon Valley Bank collapse. Banks are prioritizing safety and liquidity over real economic activity. This strategy reflects their need to shield themselves from potential financial shocks. By investing in government bonds, considered the safest assets available, banks are ensuring they have readily accessible funds to navigate uncertain market conditions. For everyday consumers, however, this means tighter access to credit, fewer loans for small businesses, and cascading consequences on job opportunities and growth. Imagine a family struggling to secure a mortgage or a startup unable to get the capital it needs to scale. These stories are becoming all too common. Young families, for instance, find themselves stuck in a cycle of renting because home loans are increasingly out of reach. A recent report showed that first-time homebuyers now face approval rates at historic lows. This doesn't just delay home ownership, it delays wealth building for an entire generation. Similarly, industries like renewable energy, which rely heavily on bank loans for development, are seeing projects delayed or canceled due to lack of funding. The consequences of this risk-averse behavior stretch far beyond the banking world. One major driver behind this behavior is dollar scarcity, a situation where there aren't enough US dollars circulating globally to meet demand. This disrupts international funding and trade systems that rely on dollar liquidity. Foreign governments pulled $80.6 billion worth of U.S. treasuries from custody accounts at the Federal Reserve Bank of New York in late November 2024. The reason? To use them as collateral for dollar funding gaps. Breaking this down. Dollar scarcity emerges when demand for dollars exceeds supply. This can happen during periods of global economic instability, where countries and companies need dollars to settle debts or trade goods. Imagine a small exporter in Southeast Asia struggling to secure dollars to pay for machinery. Without access to funding, their operations slow, creating a ripple effect on local economies. Dr. Sarah Lee, an economist specializing in global markets, explains, banks are not simply reacting to interest rates or Fed policy. They're preparing for disruptions in the collateral system by stockpiling treasuries as a protective measure. Consumers feel the impact too. Credit card interest rates rise, while loan limits shrink, leaving families with fewer financial options. Picture this. A middle-class family saving for their child's college education suddenly finds their home equity line of credit reduced. Plans are halted, and stress mounts. These cascading impacts show how dollar scarcity stretches beyond abstract banking decisions. But what's fueling this scarcity? Part of it is geopolitical. As sanctions on major economies tighten, global trade partners are increasingly reliant on dollars but find them harder to access. This dynamic exacerbates existing financial pressures, creating a domino effect of reduced spending and investment worldwide. The timing of this shift can't be ignored. On November 27, 2024, rumors of new tariffs from the US sent shockwaves through financial markets. While these tariffs didn't materialize, the fear alone was enough to push banks into defensive mode. Trade wars heighten uncertainty, but the banking sector's risk aversion started well before these geopolitical tensions flared up. Since the Silicon Valley Bank collapse in early 2023, lending to the real economy has slowed dramatically. Commercial real estate loans, for instance, have been flat for over a year in both the US and Europe. Dr. Alan Green notes, banks are bracing for uncertainty. Trade wars add another layer of risk, but the underlying issue is a lack of confidence in the broader economic outlook. Adding to this are geopolitical tensions that exacerbate risk aversion. For example, as China's economy struggles to regain momentum, global supply chains remain fragile, increasing the perception of instability among financial institutions. Visualize this: shuttered storefronts on Main Street or factories operating at half capacity because businesses can't access affordable credit. These scenarios illustrate how global tensions trickle down to local communities. Geopolitics also plays a role in shifting trade alliances. Emerging economies, frustrated by dollar dependence, are exploring alternatives like regional currency agreements. While these initiatives are still in their infancy, they reflect a growing sentiment that the global financial system may need to adapt. To understand what's happening now, we need to zoom out. So far, we've explored how banks are hoarding bonds to safeguard against risks, withdrawing from real economy lending and responding to dollar scarcity. Now, let's place these actions in a broader historical and structural context. Bank lending to the real economy has been on a downward trajectory since the 2008 financial crisis. In the 1990s, lending rebounded quickly after recessions. But post-2008, we've seen a transformative change. Lending has stagnated, and banks have increasingly turned to safer assets like government bonds. According to Dr. Emily Carter, this isn't just a cyclical issue, it's structural. Banks are responding to an environment of heightened risk perception, avoiding anything that feels remotely risky. Adding to this trend is the rise of shadow banking and non-depository financial institutions. These entities, while efficient, often bypass traditional regulatory frameworks, creating systemic vulnerabilities. Mark Taylor, a small business owner, shares his frustration. "We applied for a loan to upgrade our equipment, but the bank said no. They're focusing on low-risk investments right now. For us, that meant putting our expansion plans on hold." The generational impact of this shift is profound. Older generations benefited from an era of robust bank lending, which fueled homeownership, entrepreneurship, and wealth creation. Today, younger generations face a different reality. With banks prioritizing risk management, the pathways to financial growth have narrowed considerably. When banks retreat from lending, the consequences ripple across every facet of the economy. Small businesses can't secure the capital they need to grow. Households face stricter credit conditions, making it harder to buy homes or handle emergencies. And as growth slows, job opportunities dwindle. For instance, since 2023, loans to non-depository financial institutions, such as investment funds, have grown by 28%, while loans to the real economy have stagnated. This misallocation of capital raises critical questions about the future of economic growth. Dr. Sarah Lee explains, "Banks are funneling money into safer avenues, but this comes at the cost of real economic activity. It's a trade-off that disproportionately affects smaller players. For consumers, the implications are tangible. Rising mortgage rates make homeownership increasingly unattainable. Credit card approvals are more stringent, leaving families with fewer options during financial emergencies. Picture rising for sale signs in neighborhoods and families struggling to make ends meet as access to credit dries up. These images highlight the human cost of a banking system retreating into safety. Experts are divided on what comes next. Dr. Alan Green warns, the fact that banks are hoarding bonds suggests they're bracing for a significant economic downturn. Others, like Dr. Emily Carter, take a more measured view. This could also be a temporary adjustment to new market conditions. We shouldn't jump to conclusions just yet. One thing is clear. The banking system's behavior reflects both current economic conditions and future expectations. And right now, those expectations aren't optimistic. Could this be a prelude to a broader financial crisis, or is it simply cautious positioning in uncertain times? As Mark Taylor puts it, it feels like we're all holding our breath, waiting for the other shoe to drop. As banks stockpile government bonds and retreat from lending, the question remains, what are they preparing for? Are they bracing for an economic hurricane, or are they creating the storm themselves? This isn't just a story about banks or bonds. It's about the future of the global economy and how it might impact every single one of us. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.